Hey, it's Mike over at Cross Country Mortgage. It's Monday morning. It's November the 4th, first Monday of November. Man, I just can't believe how quick. I always say this every year. We all say it. Can't believe that fall's in the air and Thanksgiving and Christmas around the corner. But today's Monday morning. It's time for your Monday morning mortgage update for that week of November the 4th. It's a big week this week, folks. A lot of stuff happening. And really, the word of the day, the word of the week is volatility. The market started out this morning very volatile. It's going to continue that with all the stuff that's going on. So grab onto your seats and let's talk about the ride we're going to have this week. So what happened last week? I always try to give you insight about what happened last week and how that impacted the market. What's going to happen this week? What you can look forward to? How you can hedge, leverage, move, and have those intelligent conversations with people about what's happening in the market. Make decisions on buying or selling real estate, locking in your interest rate based on what's happening with the market. So let's talk about last week. Last week we saw rates get worse again. You know, we talk about rates, we talk about pricing, and we talk about interest rates, right? So pricing is the cost of the rate. Interest rate is the actual rate. I can kind of compare rates to a product that you're buying. Let's say it's a refrigerator. How much are you paying that for that refrigerator, and what's the quality of it? The lower the rate, the better refrigerator. The higher rate, you're getting a bad refrigerator or not as high a quality, and you're going to pay appropriately for that. So the pricing for rates got worse last week by 36 basis points. The week before that, 66 basis points. That's almost 100 basis point worsening in pricing. So if you got quoted a rate, if I quoted your rate, let's just use 7%. And 2 weeks ago, that rate didn't cost you any money, right? No, we call that a par rate. You didn't pay any discount points, but you didn't get any rebates back from your lender. On Friday, that rate cost you almost 1 basis point, and that's 1% of the loan amount. So if the loan amount's $100,000, it costs you $1,000. If it's $300,000, it costs you $3,000 to get the same rate in a 2-week period. So we're seeing this. We've been seeing this pattern, and I want to show you the chart here really quick because I also want to talk about what rates are doing now. So you can see since October 1st, we've seen this downward trend. That means money's flowing out of the bond market. Mortgage rates are actually getting worse. And so we've seen this for the whole month of October. But look at today, a nice rally today. That green candlestick, that green bar means that we've seen an improvement today. And actually, we saw a 33 basis point sell-off last week, 36, and we've already seen a 33-point improvement just today. So what we lost in a week last week, we gained back in the morning of today. Now, it could change. You see these little candlesticks, those little wicks on top of that bar? That shows you the movement in the market. Just it's 9:30 now on Monday morning Pacific time, and we've seen that much volatility just on a Monday. And that's without elections. That's without the FOMC meeting and all that stuff. Let's get back to really what we're looking at this week. Well, first, why last week? I used this term a couple weeks ago and last week, stagflation. It's not inflation. It's not a stagnant economy. It's both. It's weakening economy and higher inflation. Those two combinations are not good. We don't want stagflation, but we're starting to see some signs that maybe that's coming. Weakening economy, higher inflation. It's not getting under control. It's not going crazy like it used to, but it's still not under control. So let's talk about the things that are going to affect the market this week. The FOMC meeting, the Fed's meeting for their November meeting. They got 2 meetings for the rest of the year. They got the meeting this week and they have one in December. The election, that's the elephant in the room, right? So we're going to talk about that. And there's just a lot of data that could impact the market. But let's talk about the FOMC meeting. So typically the Fed meets on a Tuesday, ends on a Wednesday, but because the election is Tuesday, they're shifting that to a Wednesday start and a Thursday ending. After the Fed meets, they come out with a press conference and they tell us what they are going to do, what they decided to do. Everybody expects the Fed's going to cut the Fed fund rate 0.25%. There was talk about 0.5%, and there was talk about 0. Big expectations are 0.25%. What that means is short-term interest rate, not mortgage rates, which are long-term. These are short-term interest rates, savings rates, auto loan rates, home equity line rates, the rates that businesses are charged to borrow money. That could improve. Those rates could improve by 0.25% when the Fed does this. So that obviously impacts our pocketbooks, but it doesn't impact mortgage rates. It has a direct and indirect impact on mortgage rates. And so we'll just be watching the Thursday afternoon's meeting to find out what the Fed is going to do. And again, everybody expects it to be 0.25%. They're not going to come out with economic projections at this meeting or anything like that. They're just going to basically decide what they're going to do with that rate. But they'll talk about what they think the economy is doing. They're just not going to come out with projections. So the second thing is the election. Of course, this is causing so much uncertainty and bond traders, which is where mortgage rates are determined in the bond market, they like certainty. I've talked about this a lot. The more uncertain the future is, the more volatility we have with bonds, which in turn affects mortgage rates. So bond traders want to know what's happening long term. And bond traders right now, the other thing they do is they try to get ahead of the curve. They try to determine, well, what's going to happen in a week, in 2 weeks, in a month, in 6 months, in a year. Let's trade now based on what we think is going to happen. And the assumption is, over the last few weeks, is that Trump's going to be elected. Now, this isn't a political opinion. This is just what bond traders are reacting to. But then over the weekend, there's some conflicting news that maybe Harris has a better chance. So the bond traders really want to know, again, what's going to happen. And they're looking at not who's going to be elected president, but who's going to run the show, who's going to operate the three branches of government, the House, the Senate, and the presidency. And so, and what mixes it? We could see a Democratic president and a Republican House and Senate. We could see a Republican president and a Democratic House and Senate, or a mix all on that. And why that's important is that's who's going to be making the economic decisions moving forward. So historically, when we've seen when Trump was in office, there was stimulating the economy. There was positive economic news. That was strong economic news. What we've seen in the Biden-Harris campaign is a weakening economy, not very stimulating, and that's where the bond traders are really reacting to. If Trump gets elected, it could be bond friendly, and if Harris gets elected, it could be the opposite. So again, we just have to see. But what we're all are seeing, even this morning, is extreme volatility as polls start to come out, and everybody tries to get ahead of that curve. Okay, the last thing is data. There's a lot of data coming out this week. Bank of England has their own Fed meeting this week. The U.S. Treasury is selling a ton of debt. And will there be an appetite for that debt? One of the important debts that they're selling is a 30-year bond, and that really mimics a mortgage bond. So if there's a lot of appetite, if people dump their money and buy that 30-year bond, that could be bond friendly, and that could be interest rate friendly. We'll see rates come down. ISM services. How is the service industry doing? We've been in a manufacturing and a recession, and we've seen some weak numbers in the servicing side of our economy. Is that going to continue? The trade balance report, factory orders, are businesses buying stuff? Consumer sentiment's coming out Friday. Are consumers confident about what's happening in the economy? Or are they showing signs of uncertainty? That could impact the market. So literally every single day is a lot of data, a lot of important stuff could wildly affect bond traders. We are floating cautiously, watching to see what happens with rates every single day and paying a lot of attention to this. We can't control it. We can't control what's going to happen, but we can sure respond to it. And that's what we're going to do. So if you have any questions about the market, let me know. If you are in a position that you need to lock and you want some advice on that, please let me know. If you have a client that's locking, let me know how I can help. Forward this to somebody you think that can benefit from it. Have an awesome day, and go out and vote, and we'll talk to you soon. Bye-bye.